In this Patreon requested video, we're going to take a look at what I would consider to be the most optimal high-yielding dividend portfolio for people who don't like to pick individual stocks. We're only going to look at diversified funds, which would include ETFs and closed-end funds in each major high-yield investing category. So we'll look at some high-yielding REIT funds, BDC funds, master limited partnership funds, and so on. You can even think of this as the ultimate lazy portfolio for people who really prefer the set-it-and-forget-it approach to investing. As always on this channel, I'm not sponsored by any of these fund companies. These are all of my own personal favorites. I'll also give a disclaimer that it's possible that someday we'll get a new fund that's superior to what I'm suggesting today. I monitor all of the high-yielding asset classes out there, and I cover new funds all the time on this channel. So I'll keep everyone updated if we do get a new fund that I think has a better strategy than what I list here. But before getting started, there are a few downsides I want to list when it comes to investing in only pooled funds as opposed to holding individual companies. Depending on the investment, individual stocks will sometimes pay monthly dividends, whereas a lot of ETFs that hold monthly paying stocks usually only pay quarterly dividends. You'll also have expense ratios that'll eat away at some of your profits, and all of these funds hold at least some companies that I think are pretty poor. There are a lot of stocks in each sector that have really great track records, with many even beating the market over the long term, which I cover on this channel. But for the sake of diversification, some of these funds will include a wide range of really mediocre companies as well. But if you're willing to look past these cons, then holding only diversified funds will still be a good strategy. So we'll spend some time looking at the different options that exist in terms of ETFs and closed-end funds that hold high-yielding investments. I'll also give my input on which one I prefer in each category. We'll first look at equity REIT funds. In this category, we have a few different options in terms of the investing strategy. For both ETFs and closed-end funds, there are a lot of high-yielding REIT funds and REIT growth funds. Some of these investments only hold US REITs, whereas some only hold international REITs, and many own a mixture of both. It's really going to come down to what you're personally looking for, growth or income, domestic or international. In comparison to the other high-yielding asset classes that exist, like business development companies, preferred stocks, covered call funds, and so on, with equity REITs, it's one of the high-yielding asset classes where I personally like to target growth. Out of all the growth REIT ETFs that currently exist, the best one in terms of dividend growth, according to Seeking Alpha, is Vanguard's REIT ETF, ticker VNQ. It's also the most diversified when compared to Schwab and iShares REIT ETFs. But the exact situation that I was describing earlier is happening with this fund, which is that some of its holdings pay monthly dividends, but VNQ pays quarterly. So that's going to have to be something you'll need to keep in mind. If, however, you want a higher yielding fund and you don't care about share price or dividend growth a whole lot, my personal favorite right now would have to be the Cohen & Steers Total Return Realty Fund, ticker RFI. There are a few of these CEFs that exist, but RFI has one of the best track records in terms of dividend distributions, and it's not trading for an outrageous premium like some other funds in this category. It looks like its expense ratio is also quite a bit less than some of its peers too, which is another benefit. There are a couple of mortgage REIT funds that exist, but I personally don't like any of them, and I don't recommend investing in any mortgage REIT fund. All of the options that currently exist in terms of mortgage REIT funds hold a very high number of very poor and mediocre companies in this sector. I'm personally not a fan of 90% of companies in the mortgage REIT space, despite the high yields that they offer. Too many of them just have very poor track records over the long term. One fund that does exist is the Van Eck Mortgage REIT Income ETF, ticker MORT. It has a really bad track record, as you can see, with its share price being cut in half over the last 14 years. Its dividend history has also just been going on a constant downtrend since it launched. But this ETF is better than another one that exists, which is the iShares Mortgage Real Estate Capped ETF. This one has cratered since it launched, and its dividends have also gone down significantly in the last decade. My advice would be not to hold any mortgage REIT ETFs or closed-end funds if you don't want to hold individual companies. Every option currently available holds way too many crappy companies. Turning our attention to preferred stocks, there's one ETF I talk a lot about on this channel that I'm sure people already know if you watch regularly. My favorite preferred fund is still the InfraCap US Preferred Stock ETF, ticker PFFA. It holds a good diversified collection of preferred stocks and it pays monthly dividends. This ETF does use some leverage to increase its yield, which might sound scary if you're very risk averse, but the thing is, PFFA uses leverage on a much sturdier asset class. Another alternative that exists is the iShares Preferred and Income Securities ETF. Its yield is quite a bit less and the payout changes every month, but the lack of leverage would likely put some people at ease. With business development companies, there's two popular ETFs that exist in this sector. The oldest and most popular is BIZD, the VanEck BDC Income ETF. It's been around for over a decade, and it's a pretty good fund in terms of holding BDCs. But in my opinion, there's a better BDC fund that just launched a couple years ago that's much better, which is the Putman BDC High Income ETF, ticker PBDC. This fund launched at likely the best possible time as the BDC sector was near the very bottom, so I would not expect this great share price growth to continue. The reason that I prefer this one over the VanEck ETF is because I think this has a better strategy when it comes to picking what goes inside of it. PBDC, in my opinion, just holds better companies than BIZD. It is less diversified, but it's still exposed to 22 different BDCs, which is plenty. Just like with the REITs, a couple of these BDCs do pay monthly dividends, and yet both of these ETFs pay quarterly. But overall, I think the Putnam fund is the better choice here. Moving on to master limited partnership funds, this is actually going to be the best way to invest in these companies if you don't want to deal with the extra tax burden that they make. Holding an individual MLP on your own in a brokerage account will result in you getting an additional tax form that you have to file with your taxes. But if you hold a master limited partnership ETF, then you don't receive the extra tax form. So if that sounds more appealing, then an MLP fund is going to be your best bet. Again, just like with all of these diversified funds, these MLP ETFs do hold some poor companies in my opinion. There's a handful of these funds that do exist, with Global X, InfraCap, and Barclays offering their own products. My favorite is by a company called Alps Funds, who launched the Alarion MLP ETF, ticker AMLP. It shows right on their website that the extra tax form is processed by Alarion and that you'll only receive a regular 1099, just like with a REIT or a BDC. AMLP is similar to the Putnam BDC fund in that, despite it holding fewer investments, I like the investments that are in this ETF more than others. A runner-up in this same category would be AMZA, which is the InfraCap MLP fund. This one did have a really rough start at the beginning, but it's currently holding much better companies now, and it's up significantly over the past 5 years. For a good covered call fund, I would still go with SPYI. I've talked about this ETF a lot over the past couple months, so I'm not going to go in depth on it again. But it's still my favorite CC fund, and I love its strategy. It uses a covered call option strategy on the S&P 500, so it's well diversified and it pays monthly dividends. When looking at utilities, my favorite is still UTG, the Reeves Utility Income Trust. This investment pays monthly dividends, and it's been a pretty good grower over time, and it's well diversified across the entire utility sector. I hold it, and although it doesn't represent a big part of my portfolio, it still provided pretty solid returns. If you're looking for some infrastructure exposure in your portfolio, then the Cohen & Steers Infrastructure Fund, ticker UTF, is a good option. If you're looking for even more diversification, it might be worth considering. And with that being said, that's going to wrap up our look at a very well diversified, high-yielding dividend portfolio. You've got exposure to real estate, BDCs, preferreds, and a lot of other sectors. Again, the biggest downsides to not holding any individual companies would include the lack of monthly paying options, and sometimes these funds just hold mediocre companies. Let me know in the comments if you hold any of these investments, or if you think there's a better option that exists for what I listed. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.